special edition of ET Interview. It's been a while since the budget laid down the promise to bring India back on its growth track. However, there still seems to be some skepticism and nervousness about India's economic outlook. Ravneet Gill, CEO of Deutsche Bank India, joins me on the show today to give us his perspective on the India story. Ravneet, it's so good to have you on the show. Thanks very much.
Thank you.
How do you respond to the skepticism that you hear in the market?
So again, I think the views that we get are a little mixed with respect to how the market's responding to everything that's happened. I think there was universal praise for the way the budget came out. I think it was a very balanced budget, and in the circumstances, the government did what is supposed to be done. For the first time, I think we had a very credible fiscal consolidation story besides the growth story. And we could clearly sense that the undertone was getting a little firm. But I think in the last couple of weeks, it has weakened a little bit because of also the political events that have happened. But overall, I think there is a general belief that, we've bottomed out and we'll start going from here on.
But don't you pick up the vibe of nervousness and uncertainty that there is in the marketplace? Whether it's about business confidence or investor sentiment, there seems to be a wait and watch strategy because the bad numbers are out there, and those are stated on growth, CAD. But there seems to be a bit of skepticism about when the recovery will actually happen, or whether we've hit a trough and we'll actually stay at the bottom for a while.
I think the expectation was that immediately after the budget, you'll start seeing the investment cycle come back. That has not happened yet, and I think that's one of the reasons which has undermined confidence. The second point is that there is the general belief that on a policy-making level, the government has done everything that they could have done, but will the execution follow through? Our own sense, speaking as an institution, they will execute on everything that they have promised. The point is with regard to the investment cycle. Unlike what you've seen in the past, where it was the private sector that drove, the investment cycle or the investment sentiment, I think this time around it will be the public sector that will do that, and then the private sector will follow. I also think that in many ways, the market hasn't fully come to grips with the potential game changer that the Cabinet Committee on Investment could be. So we obviously haven't seen a lot of action, a lot of visible action yet, but we think that the CCI has the potential to really turn things around very, very dramatically.
Potential, right? Will they?
I think it will.
Okay.
So if you see the people who are taking decisions and the intent that we see is really unprecedented. So we think that the CCI could potentially change everything, and our own sense is that over the next month or so, you will see visible evidence of that.
You expect another 50 basis points to go by way of rate cuts. You think that would also, in a meaningful manner, influence the pickup in investment?
So yes, I mean there are two ways of looking at. One is that if you look at India's GDP growth, India has grown at some of its highest rates during very high interest rate regimes, which is not to say that that is something which is to be supported here. I think for cut in repo rates, for instance, to translate into economic activity and economic growth, you need to look at that as well as potential cut in CRR. So we have had 2 rate cuts now, but we still continue to see very tight liquidity. And when there's tight liquidity and deposit rates tend to be high, the transmission gets lost. So have interest rates really come off for borrowers as a result of the 2 rate cuts that have happened from the Reserve Bank of India? The answer is no. I think the RBI itself is very mindful of that, and is now looking to do this in a more holistic fashion, whether it's through OMO, through the CRR cut, and then of course the rate cut itself. So these have to be looked at in conjunction for industry to really benefit from lower interest rates.
One expectation on that front is also what happens with politics. And that decisions on investment are being kept on the sidelines till the political situation gets better. You think that's unrealistic, right, at this point?
So again, I think we aren't really qualified to comment on that. But from the way we look at it, do we see this political uncertainty resulting in early elections? Not really. With these things, you can never say. But our view is that this will tide over. Has economic policy decision-making been put on the sidelines while the political issue, resolves itself? I don't think so. I think the one fundamental change that is now happening in India is that people realize that, their electoral longevity is really going to be predicated on job creation. So 10 million young Indians come into the work stream every single year, and just to be able to create jobs for them, India needs to grow at 8%. And I think that's a realization that's now cutting across political party lines. and there is broader consensus around that. So we think now there is recognition that you can't put growth on hold while the politics plays itself out. So no, we don't think that the economic activity has been put on hold simply because politics needs to find its bearings.
You speak to a lot of foreign investors. Isn't there a sense that that if we do have an early election, that would cause a bit of chaos in the interim?
I think fair point. If India, for instance, goes into early elections, I think the physical process itself is such that it will lead to a certain amount of preoccupation. And will that mean that there will be loss of momentum and loss of focus? But 100%, I don't think that there is any denying that. And then of course the new government comes into the center and starts will have to kickstart that. So will there be a little bit of loss of momentum as a result of that? Certainly will happen, but we are quite hopeful that it won't actually come down to that.
You think the consensus target of 6% by FY14 is pretty much achievable despite whatever happens at the center?
Yes, we think that this year India should grow at anything between 6.25 to 6.5%.
You don't think that's wishful?
No, I don't think so. I still think that there is the basic demand, the domestic demand in India continues to be pretty robust. One has to recognize that it's also a little bit of sentiment that is we are at the end of the day driven by sentiment, and the moment I think the sentiment changes, which is when we see some physical activity happening in terms of fresh investment, the entire mindset could change and the economic activity could pick up. So do we believe that 6.25, 6.5 is achievable? Definitely.
What about the other key economic indicators, whether it's the CAD, which is at record levels, trade deficit, the outlook on the currency and how that's going to be managed?
So again, I think when we look at the fiscal deficit, I remember in last September when Mr. Ravneet came to the Ministry of Finance, he had said that they'll contain it to within 5.3, and there was a lot of skepticism around that, and they were able to come in at 5.2. So we think that the target of 4.8 next year is very achievable, and the government will deliver on that. If you look at the current account deficit, I think there the issue is a little more, deep-rooted. So the things that really drive the current account deficit are oil prices, which are outside of India's control. But the second thing is that if you take out crude and gold from that, India would actually have a current account surplus of 4% rather than a deficit of 6.7%. On oil, there's very little we can do. I mean, our energy needs need to be met. But as far as the gold part of it is concerned, I think more measures could potentially be taken. But in a developing economy where physical infrastructure needs so much investment, I don't think that the current account deficit is going to go away anytime soon. But does that still provide growth opportunities for market participants, corporates? The answer to that is an unequivocal yes.
Let's talk about India's attraction as an investment destination. So far India has been looked upon as an India equity story. Do you think that's changing? Do you think that the debt market in India is drawing interest?
So I think it's not as if it's changing from equities to debt. I still think that India is a very attractive story from an equities perspective. What's happening on debt really is there is growing recognition on part of investors offshore that a lot of Indian corporates tend to be constrained by the sovereign rating, and their actual inherent strength is much better than what gets reflected in the rating. So they always bet on the fact that if these corporates get re-rated, the returns will certainly start looking very attractive. So we have a situation where we've done a lot of the GC bonds that have been issued out of the country for large corporates, for the public sector, and the response for each one of them actually has been quite exciting and multiples of what we had initially anticipated. So that I think just goes to show that there is a lot of interest for Indian debt paper as well. They believe that these are corporates which have over a period of time become very efficient, have the ability to compete on a global stage. Like I mentioned to you, sometimes their credit ratings tend to get dwarfed because of the sovereign rating. But the risk return metric for these companies looks very good. So I would say in addition to the equity story, I think the Indian debt story is beginning to look a lot better. So if you see the returns on Indian paper on the debt side, it's significantly higher than any other economic emerging market. And I think the reason for that, like I said, is the skew in terms of the rating. So I think, both debt and equity, India remains a very attractive story.
What's the potential of the kind of fund flows that we can see from the debt side? For example, in India itself, first 2 months we did about $8 billion. Last year we did about $25 billion in equities. How do those numbers stack up to when you look at investment in the debt paper?
So again, I think the two aspects to this. One is the latent investor demand, which I think is huge. Second is that they need to make a few, small structural adjustments to, these segments. And I think, to be fair, for the Ministry of Finance, capital market reforms is absolutely, center stage for them. So, for instance, FI investment in debt, the withholding tax implications for that, there's a clarification that is awaited. I think if, that change comes to be, you could see significantly more appetite for, Indian debt paper. Also, I think if you look at the limits for FIs, they have been increased almost 7 times over the last 7 or 8 years, from 11 to 76 billion. They're not fully utilized, but we still feel that, if you could make these small changes on the debt side, for instance, you could see a lot more flows. We think that you could have another 20-25 billion coming. Question is that, the general view of Reserve Bank of India has been that, keep these limits under check because they want more stability. And I think absolutely faultless logic. But even if you look at, let's say, FI investment in GSEC, it's about 1.24% of the overall outstanding securities there. So it's not as if that we're getting to a point where, it could create a little bit of instability. So we think there's a headroom there to grow. And then that, along with some reforms, like I mentioned earlier, could make it very attractive.
Are GSECs looking attractive at these levels, given given the yield at about 7.9?
I would think so. When you look at, despite all that is said about the macroeconomics of India currently and the way India looks from the outside, I think investors, we tend to be a little more pessimistic about India than, investors outside do. Relative to what India represents as a credit story, I think these sectors are attractive.
What's the kind of interest that you're seeing, in terms of the funds that are buying into the debt markets in India? Because I was reading a note about how the quality of money is improving. Sovereign wealth funds, long-only funds are committing capital, are investing in the debt markets. Has that been your experience?
That's what we see as well. I think also, we are looking at more long-only investors because people feel that there may be certain issues that need to get resolved, whether it's, the political stability or, the execution of the economic reforms. So funds who invest for the short term, medium term may be a little more cautious at this stage. But sovereign wealth funds by definition are long-only investors. And they feel that the overall long-term story for India remains intact. So sometime back, I'd gone as a part of a delegation with the Ministry of Commerce to the UAE. And for instance, ADIA, committed $2 billion to fund Indian infrastructure, part of it towards the DMIC and to other projects. So I think that's symptomatic of the thinking on the part of the sovereign wealth funds that, the Indian infrastructure story could be a very interesting one. And they'd be willing to put long-term money into the country.
The tactical position that funds hold for India, are they going neutral to underweight on equities but going overweight on the Indian debt market? Is that a safe way to put it?
So I think you actually hit the nail on the head in terms of them being tactical. And you'll always see this. Investors need to be nimble, especially in a world which is much more volatile than it used to be in the good old days. I think you will see, changes in allocation. And what you said right now that, they are more comfortable on debt rather than equity, it's a fact. The question really is, we keep talking about foreign investors. I think it's also about domestic investors. So even in these equity markets, you said 8 billion came in the first 2 months, but, the domestic houses were all net sellers. So you need to be able to think that, is it that all our allocations are going towards gold, mutual funds, real estate, and not enough of that coming back into equity markets, for instance. So I think that needs to get rebalanced at some stage. And I think if we see a lot of local buying, I think that will spur on more foreign investment as well.
There has been for a long time a risk of a potential downgrade in India.
Yes.
Is the risk still there or has it gone away?
So our own view, and this is, Deutsche Bank's house view, that, we feel that risk has gone. So when you look at, the ratings of, let's say, Fitch and Standard & Poor's, those ratings happened in April and May of last year. And obviously at that time, the situation looked a lot more grim than it does now. Whereas Moody's, the rating happened in December. And it reflected in a, more stable outlook rather than negative one. So we believe that, India has shown enough progress, both in terms of, spurring growth, keeping subsidies in check, and in fiscal consolidation to be able to convince the rating agencies that a rating downgrade is not warranted. So do we see that as a material consideration when we think about India? The answer is absolutely not.
And investors also don't care about.
I don't think so. I don't think investors currently are concerned about potential rating downgrade.
As we go along, the exposure to corporate debt or G-Secs in India is only going to increase from funds. Is that the sense that you're getting?
Absolutely. I mean, that's the sense that we're getting. That's something that we believe in. And actually, the way we are positioning ourselves in India is driven by that belief as well. Mm-hmm. So, I mean, we are actually putting our money where our mouth is.
Let's talk about the Indian equity market. Now, Deutsche Bank started on the Sensex with 22,500, which is roughly about 18 to 20 times upside from 20% upside from here. What do you think will take the market higher?
So again, I think you mentioned that we had 8 billion in the first 2 months, which was higher than of course previously. But relative to the amount of liquidity there is in global markets, I think that's still a small number for a market and a country of India's size. We believe that as soon as you start seeing some physical activity with regard to progress with regard to the investment cycle coming back, corporate earnings improving a little bit, India will once again become a lot more attractive than it currently looks relative to other equity markets, whether it's the emerging world or the developed world. So our own belief is that the infrastructure story in India will start looking a lot better. Why will it start looking better? I think one of the things which has held it back in the past is really government sharing some of the risk. We think that PPP will now become a much bigger buzzword in India than it has in the past, and I think it's getting reflected in the latest plan as well. So the government, for instance, the government sharing a little bit of the risk in the construction phase. The moment that starts happening, we'll start seeing that a lot of Indian companies which are in the infrastructure space, whether it was power, roads, oil and gas, other sectors, their earnings will start looking better. So if you see across corporate India, if you look at the large caps, each one of them has a presence in one of these sectors. So when you see reforms coming about, these sectors become looking more robust. The cash flows around these sectors beginning to look up.
For all of that to happen, we need to see earnings growth kick in. And there's already talk about a potential earnings downgrade.
So we believe that a lot of what I mentioned in terms of the power sector reforms, things that may happen on the telecom side, on the road side, will actually come to pass. I think the government is really seized of the need to get these things sorted out to be able to get more investment. Also, I think in terms of being able to make sure that some of these projects which are currently stalled come on stream. And I think that was really the logic behind setting up the Cabinet Committee on Investment. So I think some of these things will come back on steam. You'll see cash generation happening again, and you'll see an earnings growth. So for instance, in 2014, we do see an earnings growth of between 15 to 16% for corporate India.
Okay, you spoke about the infrastructure space. We've already spoken about the kind of interest that the infrastructure sector is getting from the debt side of the market. You also spoke about the reduction of risk there in the PPP model. What about the attraction that these stocks hold from an equity market perspective? Do you think that will trickle down?
It will. So, like I said, that even if you look at the large caps in India, most of them have a presence in one of these sectors. It could be in telecommunications, it could be in power, or some of the other infrastructure sectors. And let's face it, that these sectors have been under pressure for the last couple of years. There are, in some cases, projects which are being built out but haven't started commercial production because of one reason or the other. Our own expectation is that the Cabinet Committee on Investment will debottleneck all these issues and provide the impetus that is required to be able to take them forward. And again, looking at the scale of these projects, I mean, just imagine if these come on stream, what they do in terms of earning growth. I mean, these are not small projects. I mean, these are all mega projects with large investments and the ability to generate large cash flows. So it is on the back of this that we feel very confident that
the market would discount that recovery within the next 6 months, 6 to 8 months?
So over the next 1 year, certainly. We certainly feel that the market will see what's happening. I mean, the parallel that I will draw is the 1999 telecom policy. It was a sector that was written off by everybody. And then, we moved from a fixed license fee into a revenue share model. And we just re-rated the sector, and we saw what it did to the telecom stocks, and also the debt that these companies were able to attract. It's quite possible that story will get replicated in some other sectors too.
Which are the sectors that you're most bullish on, and which are the sectors that you want to avoid?
We continue to remain bullish on the services sector. If you look at the FMCG sector, we continue to remain bullish on that. Even within the infrastructure sector, I think there are some players with deep pockets, very good execution capabilities. Those are worth looking at. So I would say that, our bullishness on the equities market is pretty secular and pretty broad-based.
Are you bullish in telecom as well?
So we think that, within the telecom space, there is a consolidation that's going to happen. If the industry participants talk about it, regulators speak about it. I think all the investors speak about it. And I think it could become a very interesting space once that consolidation happens.
Okay. FIIs over the last 5 years, adjustments for currency risk have not made much returns in India. When they're buying into India, what's the kind of risk-return profile that they're looking at?
So again, I think the single biggest thing that, keeps people engaged as far as India is concerned is that look at the problems that are facing the West vis-a-vis India. In the West, the problem is really demand. And the answer is that when you have a problem with demand, it's intractable. There's nothing you can do about it. Whereas India is really a supply-side issue. Nobody questions demand in India. And the good thing about the supply-side issue is with investment you can fix supply. But demand you can't fix. And to that extent, people realize that once the supply side gets fixed, India could be a very attractive investment destination. It is even today, but will become even more so.
So for Deutsche Bank, as you look at the business today, are you looking at consolidating, scaling up, scaling down? What is your broad investment strategy for India, even business strategy, so to speak?
So I think again, unlike the case with a lot of MNCs, India is very, very material for Deutsche Bank. It's a top 5 market for us with respect to profitability. And we have clearly isolated India as a market which needs significant investment and where we could generate significant growth. So if you look at some of the bigger businesses, whether it's on the transaction banking side, whether it's on the financing side, FX, we have built very strong pillars across each one of these businesses and we invest in each one of them. In fact, in some of these businesses, the intent currently is to be able to scale up our risk-weighted assets to an extent where we can double revenues in these businesses. So for India, for Deutsche Bank, India is a one-way street where we'll see significant more investment in terms of headcount, in terms of balance sheet, in terms of capital. In December, when things were looking really grim, Deutsche Bank brought in 1,000 crores of incremental capital. And clearly the intent of the bank is that as long as we can show such a good cost discipline, the quality of assets that we have, and the year-on-year growth, that this will only be a one-way street and we'll just see more and more growth.
All right. On that optimistic note, thanks very much, Ravneet, for joining us with your perspective on this.
Thank you very much. Pleasure.
With that, we come to the end of this edition of ET Interview. Thanks very much for watching.